For the first time in nearly 90 years, something happened to our economy that we haven't seen since the Great Depression. If you look at the graph, this is something that they never taught you in school, but you're gonna wanna learn about this if you have any money in the bank, the stock market, or plan on buying a house. It has to do with the US money supply, which typically predicts if there will be a shift in the economy. But that's not all. There are other factors at play that will put the stock market, jobs, housing, and even your wallet at major risk. By the way, it's Andy Coleman. I've made millions of dollars in real estate, but recently started focusing on the economy. I did it because I wanted to be prepared for Trump now in office, but what I found is way too valuable not to share. Okay, let's dive in. People may have started losing jobs as early as the second quarter of 2024, but job numbers often show up later than other parts of the economy. Therefore, this could mean the US might already be in a recession. I'm gonna show you evidence of why this might be the case, but I'll let you be the judge of this from the countless hours of research I just did to make this video. Then I'll give you my advice on what to do to prepare and actually take advantage of this upcoming shift. For a second consecutive year, Wall Street gave investors plenty of reasons to smile. By the end of 2024, the Dow Jones went up by 13%, the S&P 500 by 23%, and NASDAQ by a whopping 29%. The stock market hit multiple record closing highs along the way. It felt a bit like being at a giant festival with bright lights, exciting rides, and cheerful music where everyone believed the fun would last forever. But as history has shown, Wall Street's major stock indexes don't move up in a straight line. Sometimes there are clues that suggest this party might slow down, like a sudden flicker of the lights that makes people wonder if the music could stop at any moment. In this case, one of the biggest clues relates to our country's US M1 and M2 money supply, which has just done something it hasn't done since the Great Depression. For the 5th time in the history of the United States, the M2 money supply has dropped down by below 4.7%, which is the lowest it has ever gone next to the Great Depression in the 1930s. All 4 times this has happened led to an economic meltdown that ruined many lives, but some people also found a way to take advantage of it. I believe we're in the early stages of something big that's gonna hit the economy based on the data that I found. Therefore, I wanna share with you how I'm planning on taking advantage of it. Even though nothing can perfectly predict short-term changes in the main indexes, there are a few pieces of information and events that have matched up with the ups and downs in the stock market over time. I also took a look at the bonds market, interest rates, big government policies like tariffs, which Trump just made a huge announcement on. The newly elected president wants to place large tariffs on goods from countries like China and Mexico and Canada to boost factory jobs and cut the federal deficit. However, these tariffs can drive up consumer prices, hurt overall trade, damage the US economy by shifting jobs from more efficient industries to less efficient ones. There's a good reason why everything seems to be made overseas. All these economic factors can blend together almost like putting a bunch of different fruits and vegetables into a smoothie. It's gonna be really tough to see which ones increase which flavor or which ones make it taste terrible. But if you've done enough homework on the ingredients you used, you can make an educated guess on which ones have the biggest effect. While a strong argument can be made that a historically pricey stock market is one of the biggest concerns, a first in 90-year shift in the US money supply may take the case. Specifically, M1 and M2. The movement these key economic indicators have made are beginning to tell a story, but I think I've already uncovered the ending. Let me explain exactly what the money supply is so you can better understand why this is so important to the economy. Picture you are at a carnival, which gives you tickets to ride the rides and play the games. The money supply can be thought of like the total amount of tickets or cash floating around the carnival. If fewer tickets are given, there might be fewer rides or games people can play, and that slows everything down. Now, let me get specific on what M1 and M2 actually mean, because these are the most important of the 5 measures of our money supply. Now, picture the money supply as 2 big treasure chests. M1 is the okay to spend chest, which holds cash, coins, checking, deposits, and traveler's checks. M2 is the do not touch this chest, meaning not okay to spend. It includes everything in M1 plus savings accounts, money market accounts, and small CDs under $100,000. Let's use this balloon to represent the US economy. Normally, these chests get filled more and more each year as the economy grows, a bit like adding more air to this balloon to keep it floating. Hold this thought, because we're gonna come back to this and I promise you I'm gonna make this make sense. M1 is essentially money that can be spent by consumers on the spot. Meanwhile, M2 is still money consumers can spend but it requires a lot more effort to spend it, like a CD. Yes, you can cash in a CD, but it's not as easy as pulling money out of your savings account. Therefore, there are consequences for spending it too early before it fully matures. Normally, the M2 chart slopes up and to the right. This is to say that as the US economy has grown over time, the money supply has also increased, which reflects the need for more cash in circulation to facilitate transactions. But in those exceptionally rare instances throughout history when the M2 money supply has faced notable declines, it spelled catastrophic trouble for the US economy and, most notably, the stock market. It's like you're back at that carnival and suddenly you see people with fewer and fewer tickets right at the time when everyone wants to keep enjoying the rides. Based on data reported by the Federal Reserve, M2 clocked in at $21.448 trillion in November of 2024. This is down from an all-time peak of $21.723 trillion in April of 2022. Now, I know these numbers don't mean much to you, so let me put it in terms we can easily understand. Look at the chart on the screen here. This represents a modest drop of just 1.26% from the all-time high. Not too terrible, right? However, as you can see on the chart between April 2022 and October of 23, the M2 money supply declined by a whopping 4.74%. This is what we really want to pay attention to. It's the first time since the Great Depression that M2 had dipped by more than 2% in the history of America. Now yes, M2 has gone up since then, as you can see from the chart, but that does not mean it's going to continue to rise. However, this historic drop-off in M2 only tells part of the story. For example, because the government injected so much cash into the economy during the height of the pandemic, this caused the M2 money supply to jump by more than 26%. That is the highest jump ever recorded, as you can see on your screen. The second largest 4.74% decline that we saw between 2022 and 23 might just be a form of mean reversion after the fastest expansion of the money supply dating back more than 150 years. So let me explain that in layman's terms. So imagine you blew up a balloon really fast, so it got much bigger than normal. Then when you stop blowing, the balloon slowly shrinks just by a bit and goes back closer to its regular size. Now, that's what could be happening with the money supply. It grew faster than it had in over 150 years. And now that it's no longer expanding so quickly, a 4.74% drop might just be it settling back towards its normal level. Because as we can see on the chart again, M2 has reversed course since 2023 and is now growing. But stay with me so I can explain what this reversal actually means for the economy. An increase in the money supply typically accompanies a healthy economy. Still, the fact that we saw such a rare dip in M2 is like seeing the balloon rapidly expand, then suddenly shrink, then return back to normal. It raises questions about whether this instability might cause the balloon to shrink again. And all this expanding and contracting might weaken the balloon just enough to cause it to eventually pop. Just like that balloon, the economy is notoriously fragile. Too much instability in either direction will cause it to come crashing down like we've seen so many times. Big yearly drops in M2 have a flawless track record that problems are coming for the economy. I'm going to show you exactly what I mean by putting up each one of these times that was tied to a serious economic disaster. The chart you see shows the 1878 depression with 14% unemployment. The Panic of 1893 with 18% unemployment, the 1921 Depression with 11% unemployment, and then the Great Depression with an astounding 25% unemployment. And finally, you can see us right here during 2023. But the consequences of this are just starting to be felt today. Now, I don't believe there's going to be another depression because the Federal Reserve and many other policies that can help prevent it, but it's a signal the economy is slowing. I'm going to show you exactly how that slowdown is coming up in the jobs market, company earnings, people cutting back on big purchases like home and cars. So when you look at this graph, the housing market has the least amount of homes being sold since 1995, meaning nobody is buying a house right now. The jobs market is stagnant, having slowed drastically since it's getting increasingly harder to get hired for a new job. Just think about it. If you've been trying to get a job lately, I bet you are having all sorts of problems trying to get hired. Then the car market is finally seeing a decrease in prices for both new and used cars as interest rates are soaring over 6%. The stock market, which just hit a record peak in December of 2024, is also on its way down. Now, if the M2 money supply goes back down while inflation is going up, which it is right now, even more families are gonna stop spending money on extra things that they don't really need, which is gonna slow the economy down even more, and it's gonna make big companies earn even less. We've also heard Trump talk about new tariffs and changes in government spending, which might push inflation even higher or cause some businesses to stop hiring. Or both. I've heard talks to combat this. The Federal Reserve might increase interest rates again if inflation keeps going up. Inflation reached 2.4% in September of 2024, which is actually good, but it has been steadily rising ever since. The last report saw 2.9% in December, and the next report comes out mid-February. So it's gonna be very interesting to see if inflation keeps going up February 12th. Now, you might be wondering, why is this happening? And I'll tell you, because the Fed just lowered the federal funds rate 3 times in the last couple of months to stimulate spending. We're now sitting at a 4.5% federal funds rate, but I believe that was a mistake. Therefore, it looks like if inflation keeps going up, they're gonna have no choice but to reverse course, admit they were wrong, and raise interest rates again, like they did 11 consecutive times back in 2022, which did work to stop inflation back then, but I think they started lowering rates too soon. I don't believe the economy has recovered enough yet for this to work unless this was their plan all along. Now, stay with me, because if they start to raise rates after dropping them 3 times in a row, that will cause a major panic in the markets. And that's when the stock market tends to crash. People are gonna lose confidence in the government if they start reversing course now, and they're gonna start pulling their money out. Here's the thing, I actually believe that this is much needed for the country. So if they do this, I think it's gonna be a good thing. Therefore, I am very interested to see what they start doing going into 2025. As we already see the mortgage rates over 7%, while home prices are 40 to 50% overinflated. That makes it nearly impossible for the average person to afford a house right now, but a crash would fix that. Now, listen to this. Around 2/3 of the S&P 500's drawdowns occur after, not prior to a recession being declared. Meaning, there are periods when the S&P 500 index falls from its highest level down to a lower point, which is technically happening right now. That means that we don't always see the stock market flash red lights before the economy takes a big tumble. Sometimes it happens once the tumble is already underway. It's another reason this sudden M2 money supply drop and quick bounce back is raising alarm bells in my head. This may be an early warning sign for the markets, the same way a flicker in your lights during a storm can be an early sign that the power is about to go out. 2025 looks like it will bring big ups and downs, therefore a large drop in stock and home prices. So the big question is, how am I going to capitalize on all of this information? If history is any indicator, this presents the perfect opportunity. You know what they say, buy when the market is going down and sell when the market is going up. So I believe the perfect buying opportunity is coming up a lot sooner than we may think, but timing the market is obviously a notoriously bad idea. However, I'm gonna get a little bit risky this year. But for everyone who wants to play it safe, just play the long game. For example, if you look at the 20-year total returns of the S&P 500 since the start of the 20th century, it has generated a positive total return in 105 out of 105 20-year rolling timelines, meaning a 100% record of going up. That means if an investor had hypothetically purchased an S&P 500 index at any point from 1900 through 2004, but simply held that position for 20 years, they'd have made money every single time. But if you don't know, an S&P 500 index simply invests in the 500 largest US companies. In my opinion, one of the safest and top performing indexes that I like is Vanguard's VOO, having seen a 13.06 annual percent return over the last decade. And no, I am not sponsored by them. I just really enjoy investing in Vanguard. So if you had put $1,000 into a Vanguard VOO index fund back in 2015, you would have made $3,412 because of the power of compound interest. So even if the market does go down one year, as long as you don't pull your money out, you essentially cannot lose. But did you know the average bear market lasts 409 days and sees a market loss of 36%, while the average bull market that lasts about 5 years and sees a 180% gain. So our bull market has only been going on for about 2 years now. However, there are rare times when a bull market lasts just under 2 years. Therefore, from everything I've researched, it now looks like this might be one of those times. That's why me personally, I've held off on dollar cost averaging because I see a buying opportunity coming up this year. And if you don't know what dollar cost averaging means, it basically means buying stocks in certain intervals, like once per month, no matter what happens to the market. This way, you buy when it's high, you buy when it's low, and it all averages out to a decent price. So for me, I'm gonna get a little bit risky this year because of all this information that I found out. But I'm not a financial advisor, so take that with a little grain of salt. Now, when it comes to the housing market, I know exactly what's happening. My advice is everyone should hold off for another year or two before buying a home. Mortgage rates just passed 7%, meaning the rates are going up. Also meaning that inventory is also going up and prices are actually coming down. If you wait this out until inventory reaches pre-pandemic levels, but prices drop by another 20% or so, then it'll be time to buy right as the mortgage rates start to go down again, which I anticipate happening right around 2026. But stay tuned to my channel for updates and I will let you know when I start to see this shift happen. I'm gonna be closely monitoring the M2 money supply, the jobs market, the stocks market, government policies, so I can keep you up to date on what's going on in the economy. If you've made it to the end of the video, please drop a like for me and let me know your opinion on the state of our amazing country.